Imagine you wake up one morning, grab your phone, check your bank account, and your money is just gone. Not hacked, not stolen, not some scam email you clicked at 2 a.m. The bank itself, the actual institution where you trusted your money, has simply ceased to exist. Now, most of us hear something like that and think, okay, that's dramatic. That would never happen to a real serious bank. Maybe some shady crypto exchange, sure, but a proper bank with buildings and suits and a logo? No way. And that's exactly what over 37,000 businesses thought in March of 2023, right before Silicon Valley Bank, a $45 billion financial institution, one of the most well-connected banks in the entire United States, collapsed in less than 48 hours. 48 hours! Some companies had their entire payroll sitting in that bank. Startups that were thriving on Monday couldn't pay their employees by Friday. Founders who had done everything right, built real products, raised real money, hired real people, suddenly couldn't access a single dollar. But here's the thing that nobody talks about. This wasn't just a banking story. It was a psychology story. A story about how a very specific way of thinking, one that most of us have about money and safety, can set you up for a disaster you never saw coming. And by the end of this video, you're going to understand not just what happened to that bank, but why it happened, and more importantly, what it quietly reveals about the mistakes we're all making with our own money right now. Let's go. Here's a belief that almost every person carries around without even realizing it. Safe money doesn't need to be managed, it just needs to be stored. Think about how this shows up in everyday life. You get your salary, you pay your bills, whatever's left over sits in your savings account and you feel good about it. The money is safe, it's in the bank. The bank is a serious institution. Job done. Or maybe you're a business owner. You raise some funding or you have a great revenue month and you park that cash in your business account. You're not thinking about that money anymore. It's stored, it's safe, you can focus on growing the business. This is the mental model most people and most companies operate on. Money in the bank equals money that is protected, stable, and essentially on pause until you need it. And for the most part, this feels completely reasonable, because for most of history, for most ordinary situations, it kind of works. But here's what that mental model completely ignores. Your bank is not actually storing your money. From the moment you deposit money into a bank, that bank is using it, investing it, lending it out, putting it to work in ways you have no visibility into and in most cases no control over. And when those investments go wrong, your stored money is suddenly not as safe as you thought. That's not a conspiracy, that's just how banking works. And understanding it is the first step to understanding what happened to Silicon Valley Bank and what it means for you. Let's break this down simply, because the actual mechanics of this story are fascinating once you see them clearly. Silicon Valley Bank, or SVB as everyone called it, wasn't some sketchy back-alley operation. It was founded in 1983. It was the go-to bank for the tech startup ecosystem. If you were a venture-backed startup in San Francisco, there was a very good chance your company banked with SVB. They were prestigious, they were trusted, they sponsored events, their name was on buildings, and they were really, really good at one specific thing: collecting deposits from tech companies. During 2020 and 2021, the tech world was on fire. Venture capital was pouring into startups at record levels. Companies were raising massive funding rounds, and a huge portion of that money was flowing directly into SVB accounts. By the end of 2021, SVB had seen its deposits nearly double, going from around $100 billion to close to $190 billion in just 2 years. Now here's where it gets interesting. When you have that much money sitting in deposits, you have a problem, in the best possible way. You have more money than you know what to do with. Banks make money by taking your deposits and lending them out or investing them at a higher rate than they pay you. But in 2021, loan demand from startups wasn't keeping up with the flood of deposits. SVB had more cash than borrowers. So what did they do with all that extra money? They invested it, heavily, in something that seemed, at the time, extremely safe. Government bonds.
specifically long-term U.S. government bonds, the kind that mature over 10, 20, even 30 years. These are considered some of the safest investments on the planet. The U.S. government has never defaulted on its debt. These are the investments that pension funds use, insurance companies use. They're boring, they're stable, and in the financial world, boring and stable is often considered synonymous with safe. SVB poured tens of billions of dollars into these bonds. And now I want to use a simple example to explain what happened next, because this is the part where most people's eyes glaze over, but it's actually incredibly easy to understand once you see it. Imagine you lend your friend $1,000 and they agree to pay you back in 10 years at 2% interest per year. You've got a little contract, you're going to earn $20 a year on your money. That's fine, you're happy. Now imagine that 1 year later, your other friend is offering to give loans at 5% interest. Suddenly, your original deal doesn't look so great. If someone wanted to buy your contract from you, the right to collect your friend's payments, they'd only pay you, say, $800 for it, because they could otherwise just get 5% elsewhere. Your contract is still technically valid. Your friend still owes you $1,000, but in the market right now, the value of that contract has dropped. That's exactly what happened to SVB's bond portfolio. In 2022, the Federal Reserve started aggressively raising interest rates to fight inflation, one of the fastest rate hiking cycles in modern history. As interest rates went up, the value of SVB's existing long-term bonds went down. Not because those bonds were bad, but because new bonds were now paying much higher rates, making the old ones less attractive. SVB was sitting on what's called unrealized losses, meaning the bonds had dropped in value, but SVB hadn't sold them yet, so the loss was only on paper. Here's the key word: yet. Now we get to the part of this story that is genuinely one of the most fascinating things about human psychology and money. There is a concept in behavioral economics called social proof. It's the idea that when we don't know what to do, we look at what other people are doing and use that as our signal. It's why restaurant queues make people think the food is better. It's why we check reviews before buying something online. It's hardwired into us as social creatures. And in the world of finance, social proof is weaponized at almost a frightening scale. Here's what started happening in early March 2023. A few prominent venture capital investors, people with massive Twitter followings, people who other founders and startup CEOs actively listened to, started quietly circulating information. They were saying in private conversations and eventually in public posts that SVB might be in trouble, that startups should think about moving their money. Now here's where psychology takes over. A startup CEO gets a message from a partner at a major VC firm saying, "Hey, just thinking about diversifying your banking might be prudent." They don't have all the facts. They don't fully understand SVB's balance sheet, but they trust that VC. And if that VC is nervous, someone who does understand finance, maybe they should be too. So they move their money, which triggers another CEO to hear about it and move their money, which triggers alerts in the financial press, which triggers more people to read those alerts and move their money. This is called a bank run, and it is one of the most psychologically fascinating phenomena in all of finance, because it is entirely self-fulfilling. A bank run works like this. If enough people believe a bank is going to fail and try to withdraw their money at the same time, the bank will fail. Not necessarily because it was broken to begin with, but because no bank in the world keeps 100% of deposits available as cash at all times. Banks operate on the assumption that not everyone will want their money back simultaneously. When they do, the bank collapses. In SVB's case, it was almost cartoonishly fast. On March 8th, SVB announced it had sold a portion of its bond portfolio at a $1.8 billion loss and was trying to raise new capital. This announcement, meant to signal they were being proactive, instead set off alarm bells. Within hours, prominent VCs were publicly telling their portfolio companies to withdraw funds. On March 9th, customers attempted to withdraw $42 billion in a single day, more than $1 million per second at peak. By March 10th, the regulators had shut the bank down. A $45 billion bank, 48 hours, done. Now, was SVB's management blameless? Absolutely not. They made a classic mistake, one that has a name in finance: duration mismatch. They borrowed short and invested long. Their deposits could be withdrawn any time, but their bonds were locked up for years. That's a structural vulnerability they created. But here's what's so psychologically interesting. They might have survived that vulnerability if not for one thing: the perception of failure, spreading faster than reality could catch up. People acted on fear. Fear spread through a network, and a network moving in the same direction at the same time became an unstoppable force. Sound familiar? This is the deeper idea I want you to sit with. We like to think that money crises happen to other people, to people who are reckless or greedy or naive. We like to believe that if we're careful and responsible and we put our money somewhere serious.
But SVB's collapse reveals something uncomfortable. The very things we associate with safety can create a false sense of security that makes us more vulnerable, not less. The companies that got hurt weren't reckless. Many of them were following entirely conventional wisdom. Bank with a reputable institution. Keep your operating capital liquid. Don't take unnecessary risks. And yet, they broke one of the oldest rules of wealth building without even realizing it: concentration risk. This is the idea that having all or most of your financial eggs in one basket, no matter how sturdy that basket looks, is inherently dangerous. SVB's startup clients often had 80, 90, sometimes 100% of their company's cash in a single SVB account, because SVB was prestigious, because their VC firms had relationships with SVB, because everyone they knew used SVB, because it was easier. Social proof again. And this isn't just a startup problem. This is a deeply human problem. Think about how many people have the bulk of their savings at a single bank, or their entire retirement tied to the company pension of the company they've worked at for 20 years, or their wealth concentrated in the equity of their employer's stock because they receive shares as part of their compensation and never sell them. We default to concentration because concentration is convenient. Managing one account is simpler than managing 5. Leaving your pension where it is requires no effort. Selling company stock feels disloyal and complicated. But convenience and safety are not the same thing. They just feel the same until the moment they don't. There's another psychological pattern that SVB's story reveals, and it's one I think is even more important for everyday money decisions. It's called recency bias, the tendency to believe that recent conditions will continue indefinitely into the future. SVB's management loaded up on long-term bonds when interest rates were near zero. They made an implicit assumption: rates would stay low, or at worst, rise gradually. They were extrapolating recent experience into permanent expectation. Their depositors did the same thing. SVB had been prestigious and stable for 40 years. Recent experience said, this is a safe bank, so it will remain a safe bank. Neither group properly accounted for how quickly conditions can change. We do this with our own finances constantly. The market has gone up for 3 years, so people pile into stocks right before a correction. Property prices have risen every year in our city for a decade, so people stretch to buy at the absolute top of affordability. A company has paid a dividend reliably for 15 years, so people concentrate their savings in that single stock, assuming the dividend will last forever. Recency bias makes the past feel like a guarantee. It isn't. So what do you actually do with all of this? Let me give you 3 concrete mental shifts that the SVB story should trigger. First, understand that safety is a spectrum, not a binary. Most people think of money as either safe or risky, but that's a false choice. Everything on the spectrum between stuffing cash under your mattress and betting it all on meme stocks carries some level of risk. The question isn't whether risk exists, it's whether you understand the specific risks you're carrying and whether those risks are appropriate for your situation. SVB's depositors thought they were at the completely safe end of the spectrum. They weren't. Not because banks are inherently dangerous, but because they hadn't examined the specific risks embedded in their choice. When you think about where your money is, ask yourself, what would have to go wrong for this to hurt me? What are the actual mechanics of failure here?
You don't need to be paranoid, you just need to be honest. Second, deliberately diversify even when it feels unnecessary. The best time to diversify is when everything seems fine, because when everything seems fine is when you feel no urgency to do it, and when things stop being fine, it's already too late. For individuals, this means spreading savings across multiple institutions, not necessarily because any one of them is going to fail, but because your financial life shouldn't have single points of failure. If you're building an investment portfolio, it means not concentrating in a single stock, sector, or even country. For businesses, and this is a lesson many startups are now actively acting on post-SVB, it means maintaining accounts at multiple banking institutions and being intentional about what portion of your cash sits where. Diversification is not about being fearful, it's about being structurally sound. And third, be suspicious of narratives that make you feel safe because everyone agrees. The most dangerous sentence in personal finance is "everyone does it this way," or its cousin, "this is just what you do." Everyone in the SVB ecosystem banked with SVB because everyone in the SVB ecosystem banked with SVB. The logic was circular. The safety was social, not structural. When a financial decision is justified primarily by the fact that lots of trusted people make the same decision, that's actually a reason to look harder at it, not a reason to stop looking. The most dangerous risks are always the ones that feel normal, because normal doesn't trigger your alarm system. Normal doesn't make you ask questions. Normal just feels like the way things are. And sometimes the way things are is quietly fragile, and nobody finds out until the moment everything breaks. Here's the thought I want to leave you with. SVB's collapse didn't happen because of some once-in-a-century catastrophe. There was no earthquake, no war, no global pandemic specifically targeting this one bank. It happened because of an accumulation of ordinary decisions that each seemed reasonable in isolation and catastrophic in combination. Management made ordinary decisions about where to invest excess deposits. Depositors made ordinary decisions about where to keep their money. Investors made ordinary decisions about when to get nervous. Each individual link in that chain was ordinary, but chains don't break at the strongest link. They break at the weakest one. And when enough ordinary decisions are stacked in the wrong order, you get an extraordinary disaster. The $45 billion bank that disappeared overnight wasn't a fluke, it was a warning. And warnings only have value if you hear them before you need them, not after. Most people will watch this story from a distance and file it under interesting but irrelevant to my life. But your money is sitting somewhere right now. Your savings have a concentration profile right now. Your financial assumptions have a recency bias baked into them right now. The question is, do you know exactly what you're assuming? Do you know what would have to change for those assumptions to break? Because the people who lost sleep in March of 2023 probably thought they knew too. The best financial protection isn't the bank you choose, or the investment you make, or the amount you save. It's the quality of the questions you ask before things go wrong. So ask better questions, earlier. And if this video made you think differently about how you're storing your money, share it with someone who should probably be asking these questions too. See you in the next one. Hello, we're excited to show you our native speech capabilities, where you can direct a voice, create realistic dialogue, and so much more. Edit these placeholders to get started.